Hope everybody's having a lovely day. Good Friday to everybody. So we were talking about some things this morning. A couple of people within our team that aren't really on the finance side were asking us some questions to see if we could give some simple answers to some things that are a little bit more complicated in finance. I think Einstein said, if you can't explain it simply, you don't know anything. So here we go. Okay, somebody was trying to ask me what happens when the 2 and 10-year yield curve become inverted. What does that mean? I said typically, because they had seen it somewhere, somebody was talking about that's usually a sign for recessions fairly soon. If you look over the past couple decades, it's been a pretty good sign. So I guess all a yield curve is like a graph, right? It's so instead of the graph looking like one way, it goes the other way, right? So to make it really simply, so if you're looking at a 2-year loan or a bond and a 10-year bond, I asked the person, okay, if you were going to give me a loan for $1 million, would you give me a loan? Would you charge me a higher interest rate for 10 years, or would you charge me a higher interest rate for 2 years? And they said, well, that's simple. I think it would make sense I'd charge you a higher interest rate for 10 years because of I'd have to have the money out for longer. And I said, exactly, time value of money. That's a fairly complicated financial term, but you totally get it. It's common sense. So what happens is when we start to have liquidity crunches and you start to have markets fear with investors, it actually becomes to where the short end of the curve has a higher interest rate than the long term. And that's a sign that there's fear in the markets by financial institutions. So it's typically a sign that if you read this, it's kind of like, reading the tea leaves of what might happen in finance next, okay? So right now, for example, you can buy U.S. Treasuries, like a 6-month U.S. Treasury, and I haven't checked in a couple weeks, but I don't really trade. I'm more of a long-term investor on the things we do, and we build strategic stuff. But I do have traders that work with us and hedge for our funds and things. So when we're looking at that, right now, you could buy, I think it's in the 5% range for a 6-month bond. You hold it to maturity, you get a great rate of return. Now, so somebody's like, oh, so it's a really good time to buy short-term bonds. I said, yeah, if you're looking for a kind of a safe, healthy return, it's good. And because of quantitative tightening, normally emerging markets, so it's say Dubai or Africa or India, typically they have a higher yield for the risk premium. So when they have sovereign bonds, usually the safe bond is the U.S. Treasury. And so normally sovereigns have a higher yield, but because of tightening, raising the rates, U.S. Treasuries are the higher return and perceive less risk. And I'll leave it at that. But it's kind of put a lot of pressure on foreign bonds, because if you're trying to raise bonds for your country and investors globally buy bonds and treasuries while they've got money on their books, that's, what happens, right? So it causes, quantitative tightening is almost like a financial weapon against other countries. And it's done the same thing to currency. So as the dollar got stronger during tightening, it hurt a lot of those other countries. So a lot of the time, financial wars and monetary policy wars leads to trade wars, which can lead to physical wars, which is really interesting if you study history. Next thing that was asked of me, okay, now that we understand some things about bonds, what happened with SVB Bank? Okay, so SVB Bank, kind of like I was explaining the other day, most of the banks that I audited around the world, the big ones, they had less than 1% of cash on their books versus deposits, which is kind of frightening. I had a video the other day that kind of talks about the Glass-Steagall and where that all started and why it's probably happened. Why it's happened. But they were asking me what happened with SVB Bank. So you got to remember, SVB Bank doesn't have deposits from a lot of individuals. It's really focused in pretty large deposits for companies out in Silicon Valley, right? So SVB Bank had a bunch of those bonds on their books, but it was before the Federal Reserve started tightening and raising rates. So the bonds had a lower yield. So meaning they were anywhere from, half, I think it was probably 1 or 2% yield versus but the market now, because of tightening, is 5. So when you've got a bond, you can hold a bond, which is a loan, to maturity and get your money back. But if you've got really 10, 20-year longer term bonds, what ends up happening is you can't hold that to liquidity. You can't hold it to maturity and get your money back if you've got to sell them. So what they had on their books was they had bought a ton of bonds, and somebody wasn't doing their job and managing the treasury correctly. There should be rules in place to definitely within your fund to where you're managing the treasury. And what ended up happening was people were going in and pulling the money they had to sell off these bonds because they had a run on the bank, meaning kind of like you ever watch like A Wonderful Life when they go in and, George has had this thing and they run in and there's not enough money in the bank, so George has to go around and grab cash everywhere. That's kind of what happened in the RTC fallouts and the savings and loans in like the States, for example, in the 90s. A lot of people lost a lot of money in real estate when the savings and loans collapsed. It's when there's not enough cash, when everybody goes to get their money, which I said was a risk with all those banks before COVID in 2019, the repo market. But luckily we had COVID, and luckily we printed twice as much cash as was in existence. So anyways, so what happened was all those people came in to get their money, but there's not enough money there, so I just start selling bonds, right? But they're selling bonds that are not, they're having to sell them at a loss because there's bonds in the marketplace that have a 5% yield and theirs are only 1 or 2. So what ended up happening, basically HSBC, a bigger bank that could wait out until those treasuries mature, ended up buying like the whole bank for pennies on the dollar out of the UK. Like, it's pretty nuts, right? So that's another complicated one. What was the third one that was asked to me today? So that's bonds, that's treasuries. I can't remember the other thing they were asking. I'm sure I'll figure it out. But anyways, that's long enough for now. Been a crazy week. Super, super proud of our business development team, bringing in some new investors. Super fired up about our real estate development side. We've partnered with a major U.S. developer, and they built some cool stuff out here. They're Texas boys too. And they're going to be kind of our JV development partner. The brokerage side is really taken off. The fund side, and we're kind of across commodities, tech, energy, and real estate is primary focus right now. Stable stuff, and then we're doing some really cool stuff in the tech and how we deliver it. So we'll be having some more updates coming out soon, but hopefully I explained it simple enough. If anybody thinks that wasn't simple enough, tell me, because I'm trying to get it to where people can actually understand these complicated things, because I've always felt like the more people that can understand things, the easier it is for them to understand what's going on in markets. And I'm not going to say anything about it, but I did put a post out there the other day about this Supreme Court ruling. I don't care if you're a Republican or a Democrat. That's not what I wrote about. It's something that's very concerning, especially in the week of 4th of July when we celebrated our Declaration of Independence from a tyrant that was above the law, a UK king, then King George. And basically we celebrated that. And then in the same week, we had basically a Supreme Court say that somebody's above the law. Read what I wrote about precedent and why precedent is a bad deal, because it can actually hurt your party in the future, or a sitting president's not your party. So whether you're Republican or Democrat, it's a really frightening thing, and I think we should all be very concerned as Americans. Anyways, talk soon. Bye, guys.